Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, hello everyone. Welcome to this month's edition of our AWA Market Minute. I'm Paul Coles. With me as always is our Chief Investment Officer Scott Hoxer. We're really excited to be with all of you today. And we have a pretty interesting topic we're going to cover today, Scott.
Yeah. We thought we'd tackle the elephant in the room this year, which is the 2024 election.
2024 election. And I want to start out the conversation by saying our objective as your financial advisors, wealth advisory firm, is not to be political. And that's a tricky conversation to have talking about politics.
Absolutely. Politics, throughout time have driven strong emotions. And so I think our goal today is to, talk objectively again about potential policy and market implications and, leave the actual politics out of it.
Leave the politics out of it. Yeah. And that's the objective today. So please bear with us as we try to get through this conversation, talking about politics without being political. But I think there's a lot of implications regarding the 2024 presidential election, as there are, virtually all presidential elections. And what we want to do today is kind of separate fact from fiction and talk through kind of what really is, actual historical implications of markets or on markets during presidential election years. I think one of the biggest things that, I try to avoid during these presidential election cycles is getting caught up in the emotions that all politicians want us to believe, and that is that if we don't vote in a certain way, the way they tell us to vote, that that the fate of our nation hangs in the balance, and that kind of becomes this theme we get every 4 years. The fate of our nation hangs in the balance, and there's a lot of fear that is kind of driven to get people to vote in a specific way. And our goal today is to try to talk through, what are the actual, implications that could happen, and how do we, try to understand from our investment perspective some of the better things that we might do, best practices we might employ during these periods of time.
Yeah, and I think it's interesting, the studies show that fear elicits a stronger response from people than positivity. And so, there's almost, a function there where politicians are tapping into that fear because that does elicit, stronger emotive reactions.
Absolutely. And so with that, we have a guest panelist that's going to join us today. And Scott, why don't you introduce him?
Absolutely, Paul. So we have Fritz Folts joining us today. Fritz is a Chief Investment Strategist at 3 Edge Asset Management, also a managing partner there, and a favorite guest of ours. This is not Fritz's first rodeo with us, and we always enjoy having Fritz on. Fritz, thanks for joining us today.
Glad to be here. Always glad to join you folks and always have interesting conversations with you. So looking forward to it.
Yeah, thanks, Fritz. Our clients always appreciate your insight in the market and all things economies. And today I think we'll have a good conversation going into the presidential election cycle. So Scott, let's kind of dive into some of the history of presidential elections and some of the things that we've observed looking backwards.
Yeah, we thought it'd be constructive just to jump into some of the data that historically surrounds presidential elections. So the election years historically have been pretty solid as far as market returns. You can see year 4 in a presidential cycle, on average, the yellow bar, 7% returns as far as markets go. In a year where we have a first-term president, that return goes all the way up to 12.2%. So if history is any indicator, election years for a first-term president are often pretty good as far as market returns. If we look at kind of where the polling data is trending right now, off to the left there, former President Trump, he has clearly established himself as the prohibitive favorite for the Republican nominee. It feels like a virtual lock right now, barring any big surprises. And you can see in a general election polling, the average polling shows Trump outpacing President Biden by about 1.6 points, so within a margin of error. So it's a virtual dead heat there. As far as the Vegas betting averages, Trump is ahead by a considerable margin. And so there's a lot of kind of electioneering still to happen.
Right.
And you layer in all the things that can happen over 10 months. But as it stands today, it's virtually a dead heat in the polling. We've talked about, over in the past about how sometimes talks about presidential election outcomes are overwrought. And that is often the case. And at the end of the day, the companies that, form the stock market, they are going to try their darndest to make money regardless of who's in the Oval Office, and they are going to be nimble in adjusting to policy changes and everything else. So a lot of times the impact of a specific election is overstated as far as markets go. There are three scenarios where we typically see historical anomalies as far as market returns. And so scenario 2 right there is where we have White House control and then full by the Democratic Party, full congressional control by the Republican Party. We typically see market outperformance in those scenarios. We also see market outperformance with scenario 3, White House control and then a divided Congress. That also historically has statistically significant outperformance. And then lastly, when there's a Republican president and full Democratic control of Congress, historically that has slight underperformance.
I find this interesting, and Fritz, I'd love to get your take on this. So oftentimes I think the assumption would be that if, one party can kind of seize control, then that would be better for the economy, better for the nation, because they could get more done. But according to the history of this slide, what's teaching us, that's not accurate. Fritz, what's your take on that?
Well, yeah, no, I think that certainly traditionally markets have liked divided government because they feel that, okay, they're not going to mess things up. And I think that's what tends to happen. And oftentimes in the political arena, and you guys had mentioned this earlier, things get white hot in terms of people talking about what might happen and what the implications of that could be. But usually the market muddles through in the end, it finds its way through. And then traditionally, markets love divided government because they don't want the government to do anything too extreme. They feel that, okay, as long as we understand that we're not going to go too far in one direction or too far in the other based on one party having complete control, we feel like that is a neutral environment where markets can do well. At least that's my take on that.
Yeah, I think you're spot on. I look at this and think, markets like predictability, and if they can predict what's going to happen next, I think markets can kind of price in the next period of time and then let the market ride. But if one party or the other has too much control, then the market says, we don't know what's going to happen next. We don't know what policy changes are coming down the line. We don't know how to price those policy changes in. So markets don't necessarily act, in that kind of more positive manner. That's my take on it.
That's
yeah,
right.
I think it's the old adage, markets hate uncertainty. And when you have kind of those extreme possibilities that enter into the kind of opportunity set, that leads to, market underperformance. So that's kind of a, 30,000 foot view of U.S. elections and kind of how markets have historically performed. Fritz, in our conversations, you've talked about how this isn't just an important election year for U.S. markets. This is an important election year globally. Can you maybe speak to that a little bit?
Sure, absolutely. Well, as a former political science major, I find that this year is very, very interesting. And if you step outside of the US, we'll find that 2024 is going to be one of the most politically consequential years in history. We have national elections in more than 60 countries, and it means that half of the world's population are going to be going to the polls. More people will be eligible to vote in 2024 than in any previous year. So if you think about India, for example, they could have 1 billion people. They could have 1 billion people going to the polls to vote in their election. So the U.S. election clearly is going to have a major impact, and it's going to grab most of the news, or a lot of the news. But there's a lot going on outside the U.S. as well in terms of elections. When you have half of the planet's population going to the polls, though the results of those could have impacts in the markets and the economy.
And Fritz, we've been so focused on the Federal Reserve and interest rates, for the last 12 months. That seems to be kind of driving the narrative of the market. Do you feel like the market has priced in this upcoming election cycle, or do you feel like there's still movement that we need to expect?
Yeah, so I think what you just said is absolutely correct, that the market has been laser focused on the Fed and on interest rates, and now that the Fed has pivoted, when will the Fed start to cut rates? When will that start? How far will they go? Et cetera, et cetera. And so that's really taken all the air out of the room, if you will. However, in the not too distant future, people will turn their attention to the market. But I would say right now, the election in November is not priced in to the U.S. markets.
Interesting. That's an interesting take.
Yeah, I find that super interesting, Fritz, because, the outcomes, while not maybe as consequential as some state, are material. Maybe talk to us a little bit about what's on the ballot, both in the United States and also globally, as far as the elections go.
Sure. So one of the things, it is important just to understand the interconnectedness of all of this. And so one interesting example I have, if you step outside the U.S., is the situation in Taiwan.
Hey, Andrew, do you want to share my screen, and I'll put that slide up for Fritz?
Thank you. Great. And you can scroll right through it because it's animated, so it'll go through all the lines. It's fine.
Okay.
So we had this recent election in Taiwan, right? And the fellow who won the election was the candidate who was more focused on the independence of Taiwan. And so this is a huge issue for China, right? China was very concerned. They did not want the fellow who actually won the election a week or so ago to actually win, but he did. And so a more independent-minded government now is going to assume power in Taiwan. And so we could think about that in terms of Taiwan, but there's another interesting aspect to that, how it could actually impact, we've had this great rally in 2023, and it was driven by what they call the Magnificent Seven, these mega cap technology companies, Apple, Amazon, NVIDIA, all of those companies. Well, if you think about those companies, 90% of the semiconductors that they source come from Taiwan Semiconductor. And so they have a very high correlation to the performance of that company. And they also make up a large share of the S&P 500, as we know, because they were primary drivers of the returns in 2023. So if in fact this election triggers a more confrontational relationship between China and Taiwan, and that it could have, and if it does have, an impact on these companies' capacity to source those semiconductors, well, that could have a major impact on these huge companies, which are a major part of the S&P 500. I'm not saying that's going to happen, but it's just an interesting way to think about all of the interconnections across these elections that are taking place around the globe.
Well, and I think it's really important because we talk about the point of this conversation is to teach our clients a couple takeaways, right? And potentially think through preparation opportunities during election cycles. That point you just made about the Magnificent Seven, I don't know that everybody fully appreciates the way that the composition of the S&P 500. I think we saw a handful of people kind of raise their hand this year and say, hey, the S&P as a benchmark, did really well last year. And it kind of got people thinking maybe that's where I need to be invested is in the S&P. And I think it's important to note that those 7 positions that are in the S&P make up over a third of the weighting of the S&P. So we've got a third of the entire S&P in 7 positions. 493 stocks make up the other 2/3. And those 7 positions accounted for, Scott, was it 75%?
Yeah, about 80% of
the
return last year
of the entire S&P. So when we talk about traditional diversified portfolios, it's not fair to say, well, the S&P's got it, because that's an incorrect statement. The S&P really is not. I mean, it's very concentrated right now. And so one of the takeaways, is let's stay the course on diversification. Don't get caught up in what those 7 did last year, especially considering some of the implications that we just pointed out.
Yeah, I agree.
Yeah, and I like, one thing that you intimated, Fritz, and that's the notion of globalization. There's a lot of discussion about moving away from, the post-Cold War, global order. But for all that talk, supply chains and everything else are still highly, highly integrated. And with Taiwan specifically, people will often think of that conflict as being a full shooting match between China versus Taiwan and its allies. And it could be something maybe a little more subtle. There could be a blockade or something else where it's not a full-on war, but the impact is still material in the semiconductor space and other key technology spaces. So to your point there, Fritz, one of the risks that we have on our radar this year is kind of global conflicts, and the world right now is fairly fraught as far as the stuff going on in the Middle East, the ongoing war with Russia and Ukraine, and then the potential for stuff in the South China Sea. So how does one manage kind of geopolitical risk within the context of a portfolio?
So, well, as you know, at 3Edge, we are a multi-asset investor. So we invest across stocks, bonds, real assets, gold, commodities, and even currencies, and we invest across geographies. So I would tell you that in our estimation, the best way to protect oneself from the potential geopolitical conflicts is to be diversified. Because trying to guess which direction these conflicts will go is, that's a fool's errand. That's very difficult, if not impossible, to do. And you could be right one day, and the situation could be completely reversed the following day. So what we would say, and again, I mean, we invest differently. We're not stock pickers, so people who do that's fine. But the way that we look at the world, we're always going to have a portfolio that is diversified, wherein we're hopeful that something in our portfolio could actually hold its value or even go up in value should other of the holdings, maybe in periods where stocks and bonds don't do well, maybe your real assets like your gold, your commodities, they could retain their value. So certainly we spend a lot of time in the investment committee talking about what we think may transpire in terms of these geopolitical conflicts. But at the end of the day, the thing that really is going to protect you is trying to be as globally diversified as you can across asset classes and geographies. That's really a foundational way to protect yourself, because it's just too difficult to try to pick and choose. And I would say that in our estimation, maybe people aren't paying quite enough attention to these conflicts that just might, flare up a little more than they have. And that's not to say that they will, but I think you need to be concerned that is a possibility. And again, global diversification, and your clients have you to look after the portfolio and make those decisions. So that's the way I would play it.
Let's bring the conversation back maybe a little more domestically, back to the presidential election here in the United States. And let's talk through, and maybe Andrew, share my slide here, the potential impact of this presidential election. We touched a little bit on kind of whether or not we've seen the pricing come back in. Talk to us about kind of consumer sentiment going on right now, and what are some of the other impacts that we worry about?
So I think this is a very interesting election this year. And, you know, you can think about elections and what is the impact in a presidential election year here in the United States. And, you know, you have, well, the two candidates could be debating fiscal policy, and one candidate wants to spend money in one area, and one candidate wants to spend the money in another area. So as an investor, well, one president could benefit one sector, one president could benefit another. And those things are all still true, but I feel like this presidential election is different. It's really consequential. And one thing that I know is happening is the rest of the world is really focused on our presidential election. And so it's interesting because usually we are focused on it because it's happening here, but I think the entire world is looking at this election. And as I said earlier, it really hasn't been priced in yet. I think that will start to happen. But I think what will a couple things that may be particular to this election is, one, this really could be fraught with misinformation. You know, this whole artificial intelligence genie is basically out of the bottle now. And so there will be, I'm pretty confident, fairly dramatic degree of disinformation. Much of it will be coming from foreign government sponsored actors. And so that is going to be a wild card, because if you think about it, what does an investor do if they can't have confidence that, well, is this the fact? Are these the facts, or are those the facts? Which are the facts? You know, what is actually true? That leads to a lot of uncertainty, and uncertainty, as you had mentioned, Paul, is not what the markets need, you know, in order to do well. So I feel like there's going to be disinformation. It's going to make investors even more uncertain. Also, I think what we're going to see is the potential for more volatility in the markets. And maybe prior presidential elections, I could describe as being more stable, right? You had one candidate with certain policies, another with other policies. But I have a feeling that in this election, things are going to be said and done, which are going to swing the opinions back and forth about how the election is going to turn out. And I think we're going to have that happen. And that's going to therefore have the potential to have the markets zig and zag back and forth as we get closer to November and people try to handicap how which direction this election will go. And I think it will happen sooner, perhaps. You know, people say, well, it's not until after Labor Day. Maybe that's the case, but I have a feeling that we're going to start to get election mixing into the markets before that. And usually in an election, there's uncertainty, but then there's a decision, someone is elected, and the markets settle down. And I'm not as confident that that will necessarily be the case in terms of this election. I think whichever direction it goes, the other side is going to not necessarily acquiesce right away. So
that's a big fear. I think that it's a potential reality that either side at this point, there's so much division and so much divisiveness that's being driven that I have a hard time seeing either side acquiescing as the
Yeah, I think that they will. The way I would say is this: I think that the losing side will challenge the election, and it could be very benign. You have all these legal recourses to do that. That's fine, but I do think that will happen, and so it may take longer for things to settle back once we get through the election, and that's not typical. Usually, once someone is elected, markets settle down.
Fritz, I like that kind of synopsis of the election overall, and I do agree. I think those are some of the key risks that we face. And as we've kind of talked as our investment committee and our thesis for the year, we feel like on the one hand we have heightened geopolitical risk, which we've talked about. We have one of the most contentious potential presidential elections we've ever had. But then flip side of that, we will probably have pretty accommodative monetary policy. Fed funds futures are saying, hey, rates are probably going to go down. Corporate earnings have been resilient. Unemployment has been, resilient. And so we feel like, hey, glass half full, the real economy actually has, some resiliency and potential tailwinds, whereas on the geopolitical front and political front, there's some definite uncertainty and headwinds. Would you agree with kind of that overall, kind of thesis that we're kicking around right now?
Sure. I mean, I would say definitely in general, a central bank, the Fed, does not want to get involved in the election, so to speak, through monetary policy. So they don't want to be tightening policy to necessarily hurt the incumbent, but they don't want to necessarily be irresponsible in terms of loosening monetary policy. Now, they are in a position to do that because they did raise rates so dramatically last year. So I think that we will have rates coming down. When that starts and how far down they can come will depend on whether inflation is sticky or it can get down to that 2% target or not. The other interesting thing is oftentimes fiscal policy tends to be stimulative in a presidential election year, which makes sense. The government wants to spend and make the people happy, and so they vote to keep them in office. But that may be less likely this time because we have such a mountain of debt and the deficit is such a handicap right now. So I think that we won't get, and the Congress is so divided, we may not get as much fiscal stimulus as is often the case in an election year.
Interesting. Let's talk a little bit about kind of the capital markets in review. Sure. As we kind of wrap this up. I think a lot of people appreciate your take on kind of the economy, not necessarily the presidential election portion, but just the capital markets in review. And then let's make cases for bear and bull outcomes. Andrew, would you mind sharing my slides one more time? Fritz, will you kind of speak through kind of what you've been seeing in Q4 and currently?
Sure. Yeah, so this chart is divided into two halves. And so on the left-hand side, we're looking at, well, what happened in the fourth quarter of last year. And what we see there was the light blue column on the far left was the global equity market, and global equities did quite well. And most of that happened in the last 2 months of the year when we had this Fed pivot, as we've discussed. And so we had a very strong rally there. We also saw a very strong rally in the fixed income markets, which is the green column just to the right of equity. So they also did well because, again, this Fed pivot and the markets anticipating that interest rates were going to come down, we saw rates come down. Very, very helpful. Interestingly, gold did very well in the fourth quarter of last year, outperforming both stocks and bonds for a couple of reasons for that. One, there was the consensus that the dollar, after strengthening, was now in a position where it was going to back off and become weaker. And a weaker dollar, all else being equal, is good for gold. And so gold did well that way. And interestingly, a lot of foreign governments bought a lot of gold in the fourth quarter. And one of the reasons that they did that was to try to get away from holding all these dollars, all these US dollars, the reserve currency. They wanted to diversify away from the dollar. And one way you can do that is by owning gold. Commodities, the brown line, did not do well. And that was primarily because we saw the price of oil come down. And then the far right is cash, which, cash actually became an asset class last year, which was kind of interesting. If we shift over to the right, you see the 5 columns on the right, great year for equities last year. Absolutely. Now, having said that, equities are just now, if you look at the S&P and the NASDAQ, they're just now getting back to where they started in January of 22. But regardless, very strong year for the equity markets. A lot of that came in the last 2 months of last year. The bond market, after a horrible 2022, did quite well in 2023 because now the Fed had tightened, inflation started to come down. That's going to be helpful for the bond market. It did well. Gold, again, did well, and most of that happened in the fourth quarter. Commodities, again, really the price of oil weighed on the commodities market and concerns about the economy in China, because China is such a big buyer of commodities that if people feel that Chinese economy is weakening, it tends to push down commodity prices. And on the far right, that whatever tone of green that is, 5% return for cash in 2023. And I know the three of us remember that cash has been trash, as they say, for an extended period of time. but now cash is actually an asset class that is providing a return for investors. So kind of a different world.
Would you mind? Let's make a case for a bullish market and make a case for a bearish market.
Sure. So one of the interesting things, we did our webinar yesterday, and we asked at the beginning if people can vote. Do they think the market's going to be higher or lower at the end of this year? And it was basically 50-50. 50% said higher, 50% said lower. And I feel like that is where investors are. So the bullish narrative is we have the Fed has done their job. Maybe they were late to the party in starting to raise rates, but they raised rates aggressively. They started to shrink their balance sheet, and inflation has been decelerating. It's come down from over 9% to now 3 and change. Very good. So we have now the consensus in the market that the Fed is going to pivot. They've stopped raising rates. They're going to start cutting rates. The Fed funds future market is saying they could do 6 rate cuts this year, beginning as early as March. And we're going to get this soft landing, which means the Fed can tame inflation without causing a recession. We have a very robust labor market, so that's very good for the economy. And all of these things combined can mean corporate earnings can continue to grow. That's not an unreasonable case to make.
No.
That could happen. So that's the bullish market narrative. However,
but wait, there's more.
Yeah. Unfortunately, there's also a narrative that, is entirely possible. So the Fed has done a very good job bringing inflation down, as I said, from over 9% to maybe in the mid 3s now. But it's not a certainty that they're going to be able to get inflation down to their 2% target. It gets tougher and tougher as they get closer to 2%. Now, there are a couple things they could do. They could talk as though they're wanting to drive it to 2%, but maybe amongst themselves, they're happy with it at 3%. That will be okay. But anyway, sticky inflation, not being able to get inflation down. Well, how do you start cutting interest rates if you haven't done your job with inflation? Because as we've seen in the past, there's very often what happens is the Federal Reserve comes in and tightens monetary policy. Inflation starts to come down. They declare victory, and then inflation goes right back up. So you really, really, really need to make sure you've finished the job before you pivot. So if inflation doesn't continue to come down close to that 2% target, the Fed may not be able to start cutting interest rates as soon as they did. And you could have rates that are higher for longer, which means the cost of capital is higher. That definitely will slow the economy. The other thing is, when you raise interest rates, what we saw was the yield curve inverted, right? So we started to see short-term interest rates higher than long-term rates. And all else being equal, that has been a very reliable indicator that we're going to get an economic slowdown or even a recession. But it doesn't happen right away. There tends to be a very long lead time. And if you look at many market analysts, they will tell you that we've now gone about 13 months since the yield curve inverted, since short-term rates have been higher than long-term rates. And that's just about the average lag before monetary tightening really starts to affect the markets and the economy. So we could be just at the precipice of that monetary tightening finally taking effect. We've talked about the geopolitical risk, and one of them is obviously in the Middle East. And if that conflict should expand and we could see a wider conflict there, we could have an oil shock where you're not able to get the oil, either through the Red Sea or however that oil is coming out of the Middle East. And an oil shock is bad. That's, that is going to spike your inflation back up, and it could cause stagflation. You could put the economy into recession, but you could have a very high rate of inflation. Stagflation is what we experienced in the 1970s, and I'm old, so I remember that and getting in line to buy gasoline. It was not a good time. So again, it's not to say that this has to happen, but if you're an investor, at least you want to have this as a possibility, as a scenario B. You have scenario A, scenario B. You could believe in one more than the other, But what you want to do is make sure that I'm not betting the house on either of those scenarios. I may be leaning towards one or the other, but I also want to be protecting my portfolio in case the other scenario is what ends up playing out.
That's great stuff, Fritz. And I think that that speaks to kind of the concept of diversification in a portfolio, but building an all-weather approach in retirement. We don't want to be overly optimistic ever, nor do we want to be so pessimistic that we keep ourselves away from the opportunity to grow our investments over time. Because when you have an all-weather approach in retirement, the goal is that you've built a model that accounts for both of these outcomes that we just talked through, right? We can paint a very realistic picture for a bearish market. We can paint a very realistic picture for a bullish market. I think that having that awareness and objectivity is what allows us to be very objective in building a portfolio that says, hey, we can allow for either outcome in a retirement account and solve for cash flows, solve for the ability to, maintain your lifestyle, your standard of living, take your vacations. We don't have to run for the hills every time we get anxiety about the market if we build an all-weather strategy.
No, that's right. I mean, to me, the word that you mentioned in what you just said was the word resilience. And, I think that's really what you want to build portfolios for, is resilience.
Yeah.
You don't want to stake everything on whether you're right or wrong about whatever scenario may tend to play out, because it's getting harder and harder to actually guess what lies ahead for us. So I think resilience is really the key.
Well, we appreciate you jumping on with us, Fritz. I think our clients always get a lot of value out of listening in on some of the wisdom that you share. And I think in summary, this is a interesting year. This presidential election will be an interesting year. We're going to watch it, with apolitical eyes, and the goal there being is let's build retirement accounts that are resilient through these experiences and that are not designed for just 2024, but are designed for the next 10 and 15 and 20 years in retirement. And so we appreciate you, Fritz, and your commentary. Scott, anything to add?
No, that's it. Thanks, Fritz.
Thanks, everybody, for joining us to our Market Minute this month. And until next month, thanks, everybody. We'll see you soon.